Good evening, and welcome to the Crypto Overnighter. I'm Nikodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on Friday, April 28th, 2023. Hong Kong's central bank reminded banks that they are allowed to provide banking services to virtual asset companies. The Hong Kong Monetary Authority's Deputy Chief Executive, Arthur Wen, wrote in a column on the regulator's website. In that article, he points out that banks do have no legal or regulatory requirement to refuse to serve virtual asset companies. Wen acknowledged that some virtual asset companies might pose higher anti-money laundering risks. He also said that banks should not use this as a blanket reason to refuse to serve all virtual asset companies. He noted banks might be turning away virtual asset companies because they need to get experience in dealing with this new industry. The HKMA has released a circular to clarify best practices for banks when providing banking services to virtual asset companies. This circular encourages banks to adopt a risk-based approach when conducting due diligence and to avoid a one-size-fits-all approach to account opening applications. The Monetary Authority's move comes as Hong Kong prepares to adopt new virtual asset industry regulations. These new laws are scheduled to take effect on June 1st, 2023. They will officially allow retail investors to buy and sell cryptocurrencies like Bitcoin and Ether. Hong Kong is one of the few significant jurisdictions actively welcoming the virtual asset industry. Compare that to the US, because the United States has been downright hostile to crypto. Several prominent American exchanges have considered leaving the country due to the government's inability or unwillingness to develop clear regulations on crypto. The central bank's message to banks is a positive sign for the virtual asset industry. It shows their government is committed to creating a regulatory environment more conducive to this new industry's growth. In Hong Kong, anyway. A U.S. district court ordered the head of Bitcoin pool operator Mirror Trading International to pay $3.4 billion in restitution and penalties. The CFTC charged South Africa-based Cornelius Johannes Steinberg with fraud in June of 2022. They allege that he accepted 29,421 Bitcoin from 23,000 Americans for running an unlicensed commodity pool scheme. That was worth $1.7 billion at the time. The company is undergoing liquidation in South Africa. Meanwhile, Steinberg has been held in Brazil on an Interpol arrest warrant since December of 2021. He is still a fugitive from South African authorities. The order finds MTI liable for, quote, fraud in connection with retail, foreign currency exchanges, fraud by an associated person of a commodity pool operator, registration violations, and failure to commit with CPO regulations. In addition to the multi-billion-dollar penalty, Steinberg is permanently prohibited from registering with the CFTC. He's also no longer allowed to trade in any markets regulated by the CFTC. The former chief financial officer of a special purposes acquisition company was sentenced to 3 years in prison after embezzling $5 million, which he then used to trade cryptocurrencies and meme stocks. Cooper Morgenthau is the former CFO of African Gold Acquisition Company, and he reportedly embezzled more than $5 million from 3 different SPACs, AGAC, Strategic Metals Acquisition Corporations 1 and 2, between June 2021 and August of 2022. According to a related civil complaint from the SEC, Morgenthau wired approximately $1.2 million in funds from African Gold to his personal accounts. He reportedly used the money to trade equities and options of cryptocurrencies and so-called meme stocks. And in doing so, he lost almost all of the funds. Following the losses, he provided falsified documents to accountants and an auditor at African Gold ahead of its public filing with the SEC. This led to, quote, material misstatements in the company's financial public records. Meanwhile, Morgenthau raised another $4.7 million from private investors in a SPAC separate from African Gold. This was based on the fraudulent claim that the money would be used to launch another SPAC. Unfortunately for those investors, Morgenthau used the freshly raised capital to cover his losses at African Gold. He continued trading cryptocurrencies and meme stocks. African Gold discovered the withdrawals in August of 2022. They fired Morgenthau and informed the SEC. Morgenthau pled guilty to one count of wire fraud on January 3rd. That got him a 3-year prison sentence. He was ordered to forfeit $5.1 million and to pay further restitution of another $5.1 million. U.S. Attorney Damian Williams said, quote, "With today's sentencing of Cooper Morgenthau, SPAC promoters have been sent a message that fraud in the SPAC markets will be punished, and greed on Wall Street will be met with serious consequences." Chair Gensler of the SEC has taken another swipe at the crypto industry. In this video, he claims many crypto platforms are operating in violation of securities laws. It was a 4-minute video that he shared on Twitter, and Gensler described crypto assets as investment contracts. He called on platforms that offer crypto to register with the SEC, as he's done many times. He said, quote, "An investment contract exists when you invest money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others." That's generally what people are talking about when they talk about the Howey test. He added, "Crypto markets suffer from a lack of regulatory compliance. It's not a lack of regulatory clarity. The law is clear. If you are a securities exchange, clearinghouse, broker, or dealer, you must come into compliance. Register with us." The SEC has been at the forefront of the U.S. crypto crackdown. In the recent past, Gensler started asserting that all crypto assets are securities except for Bitcoin. Gensler believes that many crypto firms and platforms violate securities laws because they are not registered with the SEC. However, some in the industry have criticized Gensler's stance. They argue that it's based on outdated views of the crypto market, and it certainly stifles innovation. Coinbase's chief legal officer is Paul Grewal, and he argues that the SEC's position is deeply flawed. In a blog post posted on April 27th, he said the SEC threatens to upend the crypto industry. I'm pretty sure that's intentional, Paul. He continued, quote, "The SEC's position is based on a fundamental misunderstanding of how crypto works. Crypto is not a centralized system like the traditional financial system. It's a decentralized system that is governed by code and not by people. This means there is really no one entity that can be regulated by the SEC. He also said that the SEC's position is unfair to crypto companies because they are already subject to a wide range of regulations. Crypto companies are already subject to a wide variety of state and federal regulations, he wrote. He said they are required to comply with anti-money laundering laws, know your customer rules, and other regulations. The SEC's new position would add yet another layer of regulation, which would be burdensome and costly for crypto companies. Grewal called on the SEC to reconsider its position and to work with the crypto industry to develop a regulatory framework that is fair, sensible, and promotes innovation. How the SEC will respond to this remains to be seen. We do know that the SEC is serious about regulating the crypto industry, and it is also quite clear that the crypto industry is serious about fighting back. The European Central Bank is looking at how to better interact with distributed ledger technology. They recognize the need to keep pace with technological developments in financial markets. The ECB is also pondering whether to issue a retail CDBC for everyday use. The ECB is convening an industry group to help it explore how wholesale financial transactions recorded on the blockchain could be settled in fiat currency. This announcement reflects mounting interest in DLT from traditional financial markets. Some of that interest is in post-trade infrastructure that finalizes deals struck in trading venues. ECB Executive Board member Fabio Panetta said working to make the European market and financial system more competitive requires working on several fronts, not just the retail digital euro. He said the ECB already has a wholesale central bank digital currency. So now, the ECB is assessing whether its technology needs to be updated to be more easily interoperable with intermediaries adopting distributed ledger technology. Meanwhile, the UK's Finance Ministry has opened a consultation on possible new tax regulations for DeFi. In particular, the Treasury is focusing on lending and staking because both are key activities in the DeFi ecosystem. The Treasury said it wants to, quote, create a regime that better aligns with the underlying economic substance while reducing the administrative burden on users. Under the proposed changes, using crypto in DeFi transactions would no longer be treated as a tax event. Instead, a tax event would arise when crypto assets are economically disposed of in a non-DeFi transaction. This consultation will have implications for users of third-party platforms as well. Quote, the proposed tax framework outlined below is also intended to apply to the lending and staking of crypto assets, which is done through an intermediary. For the past 2 years, the UK government has moved closer towards developing crypto-specific tax guidance and policies. Starting in the 2024 to 2025 tax year, taxpayers in the country must split out crypto-derived profits on their tax returns. And now for our cover story tonight. Senators Elizabeth Warren and Roger Marshall have delayed reintroducing their crypto anti-money laundering bill in an effort to recruit more co-sponsors. Apparently, they're having trouble finding people to sign on their regressive anti-crypto legislation. How sad. The bill was first introduced in the Senate last session in December. It would require the crypto industry to abide by Know Your Customer rules. All of the industry. All of the way down to individual miners and validators. Industry members expected the bill to be reintroduced this week. That didn't happen. Insiders say that the senators have delayed it because they want to find more co-sponsors. The latest version of the bill text, which has yet to be publicly released, apparently includes the very same language opponents originally found troubling. The following groups would be responsible for adhering to KYC policies: unhosted wallet providers, digital asset miners, validators, and independent network participants. This legislation just goes too far. These expectations are entirely inappropriate and all but impossible to attain. Here are some additional details about the bill. The bill would require crypto companies to collect personal information about their customers, such as their name, address, and date of birth. The bill would also require crypto companies to report suspicious activity to the government. So who decides what suspicious is? Opponents of the bill argue that it would stifle innovation in the crypto industry and make it more difficult for people to use crypto. It remains to be seen whether the senators can even find enough co-sponsors to pass the bill. I wish them the worst of luck. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, maybe leave a rating. And in the meantime, we'll see you tomorrow night.